Welcome to Stock Trades. In this video, we're going to go ahead and discuss some thoughts on the market. Okay, this is a live video, so if you have any questions, if you're up right now, comment down below. So we are experiencing some turbulence within the market, and I'm seeing a lot of investors that are not legendary, but they have done well in the past, say some things that we definitely need to talk about. So it's hit the media. The 10-year has hit an all-time high in the past, since 2008 or something, right? We knew that it would do that because we attended the federal, the FOMC, and they gave us the federal funds rate, and they said that expect to see it at 4.6, and the 2-year is the bond is a predictor of where the federal funds rate is going to go. So now what we're starting to see, and we've been seeing this. The 2-year is worth more than the 10-year. Okay. So a lot of people now that don't understand the market are basically saying, I would rather put and park my money in treasuries than investments, stocks, X, Y, and Z. Okay. Well, that type of thinking is actually wrong. Okay. By the way, thank you so much for joining, Manny. That type of thinking is wrong because, and I could just direct you, I believe chapter 2 of The Intelligent Investor by Benjamin Graham, written in 1949. When you go ahead and take a look at your returns, you get your returns and you subtract them from inflation, right? When you have a bond, let's say a bond would give you 4%, right? As of right now, around 4%. Well, if you subtract inflation, which is 8%, then you are going to be you're going to be negative 4%, and we don't even know what's true inflation, because the government data is kind of not as accurate as one might say. So we don't really know what the true inflation is, but based off of the inflation that we have from the government, it is approximately, let's call it 8%. So you're going to be down negative 4% on your money. If you invest in a bond, you're just going to be swimming backwards. But then you can go ahead and argue and say, well, Al, I'm down. I'm assuming, let's call the S&P 500. I'm down 20% to 80%. What 4% being down 4% on my money seems like a pretty damn good deal. Okay. Which, if you purchased at the peak of the market, then of course, this is a philosophy that stands corrected, right? However, based off of the prices, like let's just take one case study, Clover Health. We know, and there are other stocks out there, we know that Clover Health is in deep value territory, okay? Deep value, okay? What does deep value mean? It means that the price is heavily discounted, and it's discounted on top of discounted rates. You have the SPAC discount, right? Then you have the penny stock discount, and now you have the under $1 billion market cap discount. There's different types of discount rates that the market puts on a company, and the discount rates on a company, the more deleterious the price is going to be. Okay. Again, did we talk about anything so far about what's intrinsically wrong with the company? The answer is no. We'll get to that. Okay. Then on top of all this, now we can talk about fundamentals, is that this company is losing money. Net income is negative and free cash flow is negative. But you can argue and say, but Al, a couple months ago, heck, 6 months ago, a year ago, the stock was trading higher. Why was it at $28? Well, then whoever tells you that market economics doesn't sway the stock market is lying to you. The interest rates at those times was 0%. So the market had patience. The market said, okay, well, these stocks are undervalued here. I'm looking for a very sexy return. Like, they looked at the Apples, the Microsofts. What were you honestly going to get? 10, 20%? So the market wanted to take risks. So it pushed stocks like Clover past its intrinsic value, because remember, I wasn't talking about Clover when it was $28, $18, $16, or $15. I talked about Clover specifically when I saw the direct contracting lives coming online, and I saw that, okay, I see where they're going here. They want to compete with the big dogs, okay? I'm giving you example, one case study. The issue here is that a lot of stocks fell. A lot of stocks just dropped down into the gutter. So as someone, let's say, if I didn't know nothing about investing, I would say, dude, all these stocks are trash. Why is this stock high and this stock low? It must be trash, right? But that's the thing. Clover is about to become free cash flow positive and net income positive. They have to. The market is going to cripple them. The market's going to bankrupt them out of the market, right? That's what it's basically signaling. And as the president, CEO, they're like, okay, that's it. We understand. We get the message now. We get it. We got to do it earlier. No problem. Now, personally, I don't mind it losing cash and all that. I don't mind it if we had a 0% interest rate so they can grow. It's like free gasoline on the fire. But sadly now, they're going to have to do strategic growing. But the good part about this is other companies have dialed it back down. Some more than others, like Bright Healthcare, coming out of just all out of states and now only staying in a little bit. Okay? So this is the argument now that most people are saying. Well, I'd rather be in cash, but if you do that, you'll lose cash. And this will get you to the part of the video that is going to be the most important, okay? The market is changing. I believe that this is near 0% interest rates that we've lived with for the past 10 to 15 years, unfortunately, has come to an end. So this is good for us in the mastering group because it's going to fall upon value investors and fundamental analysis investors to find stocks that are of fair value that will give you a nominal return. Okay? So what are the type of stocks that are going to protect you? Because the argument was, well, Al, I would rather take that 4% bond than be down 20% on the S&P 500 and on top of that lose 8% of my money on inflation. Come on, Al, right? But the difference between owning a bond versus a business is that a business has pricing power. A business can raise the price of its goods for sale so that it offsets the cost of inflation. I'm going to say that again. A company, a stock, a business can increase the cost of goods sold to offset the rising cost of inflation to pass it down to the consumer. Okay? Bonds don't do that. So it's 4% minus the CPI if you want to just call it that. We'll make it simple for this video. It's a little bit more complex, but we'll do the 4% minus 8%. You're down. Okay? Versus a business, let's say like Coca-Cola, they can raise the price of the goods sold, then we can go ahead and offset inflation. Now, why the hell did I say Coca-Cola? Every word I'm saying in this video is strict. There's a reason. Stocks right now that are going to be successful are going to be the ones that give you a free cash flow, that are payout ratios not given by debt. A payout ratio is usually I like to look anywhere. If it's over 50, their debt to equity is most likely over 0.5. Okay. Stocks like utilities. Remember I told you this earlier? Stocks like, oil, gas. I talked about oil and gas in November. If you can track my videos in 2021, we made a 70% return. We outperformed the market within those stocks. Great. Okay. Other stocks did more. Unfortunately, I mean, I'm not really that much. I sold and the price really hasn't changed much on these types of stocks. Actually, My apologies, they have. ExxonMobil now is 106. We got rid of it at around $85, $90. So there you go. Why is the market prefacing ExxonMobil and a bunch of those utility stocks? I found some that are undervalued. We're going to put in our price target list. Why is the market advocating for this? Because it gives you a free cash flow. Because it's a commodity. Commodities are going to win. I hate to say this, but potentially, you might see gold a little bit. But gold, honestly, let's look at the gold prices here. Because gold doesn't carry any intrinsic value in terms of its ability to make more of itself. It's just a point where it's money that changes with the printing velocity of the global world reserve currency, which is the United States. But overall, we are seeing gold prices go down. Now, I can try to find a way to do an intrinsic value calculation on gold. The only way to do it is probably doing a gold miner stock like GOLD, Barrick Gold, and see what their intrinsic value is and to see exactly what they are trading at in comparison to the price of gold to give me a hedge whether the market thinks gold is undervalued or overvalued based off of the discount rate and the price of what gold is trading at. So that's a little complicated, but but as you can see now, we're slowly steering into utility stocks, oil, gas, commodities, Coca-Cola, stocks that Americans are not going to give up. Now, you can see that Apple iPhone has started to peak. They sold their 2021 sales and 2022 sales. We're starting to see a peak in the amount of iPhones being sold. In fact, Apple said they're going to decrease production in the iPhone 14. Okay, so what are we starting to see here? The economy obviously is slowing down. That is going to make people say, you know what? I don't need to upgrade. I don't need a new phone every year. Maybe every, 2-3 years. Parts of the economy that's not being struggled, they can get their new phones, and then after a year, they can sell those back to Apple, and other people can buy used iPhones. Regardless of the matter, we had a surge in new computers being bought in 2020. The amount of technology within the tech sector of materials being bought is going to decrease, which is going to impact earnings of the big wicked companies such as Tesla, Apple, and Microsoft. I would have said Facebook, but they've already been demolished. So what do we do from here? Well, stocks like, I believe in the next 5 to 10 years, my prediction is that stocks like Cathie Wood stocks are going to be garbage. Stocks that have not proven themselves to have a sustainable future free cash flow, that have a sustainable business model. If you are going to use the market's money to build your pipeline dream, go to venture capital. The stock market is going to be closed for business for these types of companies. Companies that are going to be successful. What is success? Free cash flow positive. Are they growing their free cash flow? Gross margins. Do they have a high gross margin return? Are they either buying back stock buybacks, which adds value to the shareholder by removing the outstanding shares or the shares that are being traded, thus increasing your share ownership of the company? This is where the market is headed for the next time being until the Federal Reserve pivots. Now, I don't think they might pivot this time. If they do, don't believe the bounce that you're going to see and don't start YOLOing into garbage trash stocks that don't have proof of concept. Clove has a ticking timer now, about approximately a little more than 24, let's call it 24 months by 2024, 2025, which we've been saying for the past year, Clover needs to show proof of concept for free cash flow and net income positivity. Now, in terms of all the other stocks that you guys are looking at, you guys need to look at the bottom line. You got to calculate their value. You have to see, and this is going to be important more than ever, okay? Now, in the next couple videos, we'll talk about China. China stepping in to buy back their stock because to stop this market crash that they're experiencing. Europe is about to fall into a depression. I mean, you know, they're in a big problem. And right now, we want to see what is the Federal Reserve going to be doing. And I think the best course is to beat down inflation. But the only stocks that are going to be doing well are the ones that are going to be giving you money, whether that's buying back stock or issuing a dividends. Those are the stocks that are going to be very successful. Okay. This was a very long video, 16 minutes. I've made longer, but I hope this gives you a mental plan of where I think the market is going. The fact of the matter is I believe growth stocks will do well, but the issue is it is now tumultuous. I mean, we're talking Microsoft now is going to start becoming like a value stock where they're going to be buying back their shares and doing strategic growth. We're talking about Tesla perhaps starting to do a share buyback program. Unheard of, right? Comment down below what you think if you're watching this video not from a live perspective, and I want to know and read your theories on where this market is headed. But it's very clear right now, the purpose and title of the video is that the market wants retail investors to capitulate. The faster they sell, the better it will be. And we're starting to feel that as our group in our stock trades, we're starting to say, man, I really want to get these retail investors out of there, right? Which sucks because our mission is to help retail investors, but we can see that they can be annoying sometimes. And we want institutions to come in because that'll bring price stability within a particular asset. So it's a catch-22. I mean, it's a double-edged sword. You know, you want retail investors to win, but sometimes they don't really do much for the stock, right? So there's that, okay? And I personally believe that the market wants, I mean, even President Biden was saying, the market wants the retail to capitulate. The issue is many retail investors are now educating themselves. There are YouTube channels dedicated for this to teach retail investors about this. Investopedia, all these different things to help retail investors thrive. Wikipedia, all these different things, right? And the biggest thing right now is that many physicians, lawyers that own index funds are holding. They know not to sell, but back in the day they would sell, right? They would sell, but now the market is slowly getting stronger and smarter. So that is the issue that the market is experiencing, and they want retail investors to capitulate. The question is, when is that going to be? Oh yeah, the microphone is modulating. Maybe I'm speaking too loud. I'm getting too excited. I'll rewatch the video and then I'll do a test trial to make some adjustments. If I hold the microphone like this far away, is that good for you guys? Is that good? Should do some test trials. They always say to bring this mic close like this, but I don't know. It's a new mic. Pepsi raised prices to hit profit. This is what happens. Absolutely. And I'm happy that you're here. And the goal is we're trying to help investors thrive in this market. All right. I've been in this for 10 years and a little bit more now. It's going to be, it just sucks getting old. But by the time, imagine 10 years from now, our private group will be people in there that are 10 years, and it's going to be good. It's going to be good. But love each and every one of you. God bless you guys, and I'm happy to give you guys this insight. Comment down below, what is your insight? Because that's how we grow together. Because sometimes I may not see the whole picture, right? I mean, I only got 2 eyes, right? So the more eyes we have on this, the better we can come together and make a thesis. But this is from my experience, what I'm seeing. But I love each and every one of you guys. God bless you. Stay safe. It's a crazy world out there. And, stay safe, and make sure, there's a lot of, I don't know why, but it's just a lot of motor vehicle accidents right now we're having here. And, just people dying left and right. Just be careful with that. Wear your seatbelts, take care of yourself, take care of your health, take care of your sugar level. Diabetes is a terrible disease. Just make sure you take care of yourself. And it's with the market in America. You don't bet against America. The market's going to do well. Okay. All right. God bless you guys.